Good morning. It's Dan Russo, the Chief Market Strategist at Chaikin Analytics, bringing you your update on the current market environment for October 4th, 2019. Jobs Day in the U.S. The non-farm payrolls report for September came in a little bit weaker than expected. However, the unemployment rate here in the U.S. Did fall for the month of September. So let's dive in and see what's going on in the U.S. equity markets and some of the key themes and relationships that we are looking at. So far for the S&P 500, we are holding the key 290 level. After back-to-back 1% declines, we took out that key support level at around $290 for the SPY. But we got back above it yesterday, and futures are trading higher here this morning on the heels of that payroll report. Now, for the SPY, we do have a bullish ETF power gauge rating. However, the trend is weak as we remain below the long-term trend line. The fund is oversold, and money flow has remained bullish despite this pullback, and SPY continues to outperform the IWV. That's the Russell 3000 ETF, and that's a sign of large caps outperforming small caps. Now, what we would love to see is we'd love to see this gap get filled. The gap that opened on Wednesday morning and stayed open throughout the day and yesterday, we want to see that get filled. First step was getting back above 290. We've done that. Now we want to see the gap get filled to give us some more encouragement. With the market remaining oversold, I think that that is a likely outcome. However, if the gap is not filled and if we continue to fail below 290, we have to start thinking about where the market could go. The August lows from this range are at around 282, and then below that 273 back here to the June lows. So just laying out the roadmap for the S&P 500. Ideally, a hold above 290 is what the bulls want to see. Bearish investors want to see a move back below 290 to set the stage for support breaks at the August lows and ultimately a test of the June lows. That's the playbook for the S&P 500. Small caps continue to lag, but they are bouncing at support. Remember, we've been highlighting the support level for small caps for a while now at the 145 mark. Resistance well defined up near 160, but let's take one step at a time here. So far, we have held 145 support. The fund is oversold and money flow is actually bullish. The biggest key for us is the underperformance, right? The relative strength. What does that mean? All else being equal, if we're trying to choose between two investment ideas, we prefer the one that is larger cap in nature, as small caps have a relative headwind. Looking at the fund itself, the IWM, the iShares Russell 2000 ETF, does have a neutral Chaikin power gauge ETF rating. And here too, the trend is weak with the fund below a declining long-term trend line. So first step here would be for support at 145 to continue to hold. Then obviously we want to see a break above the trend line and ultimately a break above 160. But for us to get really excited about small caps, we're going to have to see an improvement in relative strength. So far, that has not been the case. The Qs, however, are seeing some improving relative strength this week. You have to squint to see it, but it's there. QQQ has a neutral Chaikin power gauge ETF rating, a weak trend as well below the trend line. Fund is oversold with bullish money flow, but after seeing declining relative strength through much of September and actually a brief trip to the negative side, we are starting to move topside again on a relative basis. To me, this is a sign that investors are starting to reevaluate that growth versus value theme and potentially coming back to the growth stocks as economic growth, both in the U.S. and globally, continues to slow. We're going to take a look at what that means in just a little bit. Remember what our thesis has been pretty much since the March timeframe, that in a slowing growth environment, you want to favor areas of the market that are leveraged to growth, i.e. growing, but also in a slowing growth environment, it's going to be hard for yields to get much traction to the upside. So you want to also highlight and favor names that do well when yields are declining. So what does that mean here? Here's our indicator that global growth is slowing, something we watch on an everyday basis. We write about it in our note every Friday. It's the copper to gold ratio, right? Copper is an industrial metal, widely used throughout the economy. When the economy is strong, copper tends to do well. When the economy is weakening or investors are concerned and seeking safer assets, they tend to gravitate towards gold. And as we can see in this ratio, copper has been lagging gold since May 2018. Steady downtrend below a 200-day moving average, took out support, which is now resistance to any upside move. So the downtrend here in the copper versus gold ratio confirms the views that growth is slowing. And we saw evidence of that this week with the ISM manufacturing number coming in weaker than expected, the services number coming in weaker than expected. We would continue to expect copper to underperform gold, and that lines up with our view. Now, if you are looking for a base to build, you're going to look for support to start to hold here and for the RSI to begin to shift higher. Early signs of that, but we're not out of trouble just yet as far as this ratio is concerned. Obviously, it's something we'll be watching closely, but so far we are not seeing enough evidence of a trend change to get us to change our overall view on markets and strategic allocations, if you will. Investors are still risk averse, right? Here's more signs of what we're talking about. Here's the ratio of high yield, HYG, to IEF, intermediate term treasuries, right? When investors are risk seeking, high yield bonds should outperform treasuries, right? Just kind of makes sense. High yield bonds are riskier than treasuries. So in a risk on type environment, high yield should outperform. That has not been the case for a year. This indicator or this ratio topped out last September and has continued to move lower, below a declining 200-day moving average, recently breaking below support, tried to rally back, and then reclaiming and re-breaking below. RSI could not become overbought on that rally and has now moved back to bearish ranges. So when we start to think about how investors are feeling about the market, they are still risk averse. If you read my note every Friday, all of the key themes and relationships for the most part point to that. What does that mean? Does that mean you just run for the hills? Absolutely not. You skew to the areas that are outperforming. And the areas that are outperforming are the areas that tend to do well when investors are risk averse. Now, in the short term, breadth is oversold, right? The percentage of stocks in the S&P 500 currently above their 20-day moving averages is at 16% after tagging the 11% mark. We highlighted this in our note yesterday and said we were getting close to levels that would say that near-term breadth is oversold, and those oversold levels tend to coincide with local lows in the S&P 500. Look at what happened back here in the August timeframe. Got down near 10%. Market started to put in a bottom. Last year, at the end of the year, obviously, it doesn't have to stop at 10%. It can't overshoot. But undercutting 10% was a sign that we were getting close to the low here in December. Same thing happened back in the fall. You can see it numerous times over the course of the past 2 years. When this indicator gets down here near the 10% level, it is a sign that we are oversold from a breadth perspective in the near term. It tends to mark near-term rallies. And then right on cue yesterday, S&P 500 staged that key reversal, and futures are continuing higher here today. At the same time, we have a possible bearish extreme in sentiment. Looking at the 13-period moving average of the CBOE put-call ratio, you can see that this metric has rallied over that 1.1 mark that tends to coincide with local lows for the S&P 500. You can see numerous times over the past 5 years when this indicator has gotten over 1.1%, it has marked a level where the S&P was close to bottoming out or bottoming out. So we're starting to see that take place here again now. So oversold breadth in the near term, bearish extreme in sentiment, to me, increases the odds that we're going to fill that gap. Does it have to happen? Absolutely not. And these do tend to be shorter term in nature. Just something to think about as we're connecting the data points and connecting the dots here in our view of the market. Yields do continue to move lower. Here's the 10-year Treasury note yield down back below 1.6%, below a precipitously declining 50-day moving average, a declining 200-day moving average. Notice that spike a few weeks ago could not produce an overbought condition for the RSI, which promptly has turned lower with price. What you'd be looking for here to see signs of a base building in Treasuries, or in the yield rather, would be a continued bullish divergence. If we test support at 1.5 and RSI can't become oversold and marks a higher low here, that would be signs that a base is building. We're not there yet. Yields continue to drift lower, favoring the bond proxies in the equity market, and sector momentum supports the views that I've laid out, right? In a slowing growth environment, you want to favor yield plays and growth. Well, what's outperforming over the past 6 months? Yield plays and growth. Now, tech is down over the past 6 months. It's just down, it's up 3.2% over the past 6 months, which is better than SPY. Notice the groups that are outperforming. Utilities, real estate, staples, that's your defensive posture, with utilities and REITs as your yield plays, and tech is your growth proxy, right? So our thesis is playing out. It continues to play out. It has been playing out since the March timeframe. Again, you can skew to the areas of the market that are outperforming, and we've laid it out for you here. What's interesting to me is that all 4 of these funds have bullish, or in the case of utilities, a very bullish Chaikin Power Gauge ETF rating. So what do we want to do? I want to screen for classic bulls and then find the ones that are in the leading areas of the market and get them when they are oversold. I've limited it to the S&P 500 here, but I've screened for what we call Chaikin Classic Bulls. What's a Chaikin Classic Bull? Well, it's a bullish or very bullish stock that's outperforming the market with solid money flow, right? And ideally, we want it above a rising long-term trend line. So a quick use of the screener, which we've pre-populated for you, right? Our preset starter screens. You can screen for classic bulls. You can see a lot of the names are in those leading industry groups and areas of the market that we've been highlighting, right? So you want to identify, you have 18 stocks here to look at. You can identify the ones that have become oversold and meet the criteria that we often talk about for adding a name to the portfolio, but it's a quick way to find the names that are most likely to outperform. So what do we want to do here? We want to see the gap close in SPY. Sentiment and breadth point to a near-term bounce, and that does appear to be playing out. Slowing growth favors growth in yield plays in the equity market, so we want to focus on adding classic bulls in leading groups when they are oversold. Drop down the checklist. Right? Every stock, we give you that checklist where you can quickly see if we think it makes sense for you to potentially take a position in the name. Look for the green. Support the weight of the evidence. We do the work for you. I hope that everybody has a great weekend. We will be back here next Friday with another update on the markets. Have a great weekend, everyone.